Welcome to another Evergreen Ratings Manager video. My name is Angela Ashton and I am the Director and Founder of Evergreen Ratings. And today I'm joined by Paul Miron from Msquared Capital to discuss his two funds and private credit in general. Thank you today for making the time, Paul.
Thank you, Angela.
Would you like to tell us a little bit about why you started Msquared?
Thank you, Angela. That's an excellent question. About 10 years ago, my co-founder Paul Miliotis and Jana Miron as well, who's co-founded the business, we sat at a round table and we had our own independent financial services businesses. And we sat down and looked at the market and we saw a significant gap in the market in relation to private credit. So there's very high covenant borrowers out there being frustrated and finding alternative finance solutions. And then you have a significant amount of investors who want to participate in the market, but with all of the great features that private credit have, is that you've got regular income secured by property, which is, in our case, paid monthly as well, and them getting access to it. There's a big gap in the market, and that's why we started Msquared Capital.
Both your funds are secured by real estate. Would you like to tell us a little bit about why that's the case, why you've chosen to do that?
Absolutely. So private credit covers a huge range of different type of mortgages, debt facilities. There's a couple of things that people need to really understand when they're looking at private credit. It's not a homogeneous product.
Yeah.
So, asymmetric risk is really, really important. So, there's no upside in relation to when you're investing into debt, but what's really important is that asset preservation quality. Now, the quality of borrower is one side, but the security is also quite important. So different type of security has different inherent risk in different type of markets in relation to how you're going to recover. So that's the whole purpose of debt, is you're taking security when the borrower is unable to repay. So if I am actually lending against a residential property in Metro Sydney and I have to recover it and I take it to market, it's a very liquid asset. Put in the market, it can be recovered quickly. But if I lend against something which is specialized, like for example a rural property, which we don't do in Msquared at all, and the reason is not because we don't want to support rural farmers and things such as that, is that it's a highly illiquid asset. So even though you might have a very low gearing associated with it, it could take years and years to actually recover your money. So it all comes down to the quality of asset, how recoverable it is, and that what defines the quality of that asset preservation. There's a lot of private credit out there at the moment which is not secured by property. It can be secured, it can be unsecured, it can be secured by business. And if there's a failure of business, you can lose your capital. So it's not just return on capital, it's really important to think about return of capital.
Msquared offers two funds, both of which pay monthly income to investors. Please tell us a little bit about the first fund, the Mortgage Income Fund.
Yeah, absolutely. So we set up that fund with really high conviction in relation to asset preservation qualities.
Yeah.
We've actually gone back to our investors and we said, what is the type of fund that would be most comfortable for you given the type of environment? So we have a lot of a lot of self-managed fund investors, religious groups, and the key aspect that they said to us is that we want a very low conservative gearing. So at the moment it's offering, the gearing at the moment is about 55%. But the most important thing is when it's like an onion, when you start peeling back, what are the risk associated with the asset classes that we have in it. So we have no construction debt. It's a pure first mortgage, which is very, very critical in relation to asset preservation. We have no rural land, and it is all Metro Sydney at the moment as well. So it is actually defined excluding all specialized securities as well. And this is really, really important. So the investors who invest in that particular fund, they understand that we have a very high conviction in relation to making sure the asset preservation quality is as strong as it possibly can be. It's currently diversified with over 30 different loans, and we're currently paying 7.8%. So the attributes in relation to that particular fund were very carefully put together and thought through to make sure that it meets that requirement for those investors that we have.
And the High Yield Fund?
Once again, very similar, but it can do a little bit of construction. So at the moment, we only have 4% in construction. It's still a very, very low amount. The gearing on that one is slightly higher, and therefore we reward our investors with a higher return there. Currently, it's paying 10.3%. it's double digits, and we envisage that we can do that for a lot longer as well. We can sometimes do second mortgages, and we are very selective in relation to the deals that we do. But once again, we don't do rural property. We don't do those specialised securities in that particular high yield fund. We can do a little bit of land. At the moment, it's sitting around that 10%. So once again, we can go a little bit higher in rate, but it's not just about the rate. What is really important to us, we're looking at the whole economy, we're looking at the property market, and it's all about managing the highest quality risk, not just the return.
So capital preservation is obviously key in these sorts of funds.
Yeah.
Would you like to take us through some of the steps that you undertake to ensure that capital preservation is maintained?
Look, if you look at the entire market that we have with private credit, we've had an unbelievable run.
Yeah.
And so once again, there are certain aspects of the market that we think there is some risk to it. So for example, Howard Marks says, the best of loans are written in the worst of times, and the worst of loans are written in the best of times. I don't think that we have actually seen the full effect of some of the bad loans that have been written in the marketplace. And that's why we have such a low threshold in relation to certain asset classes like construction.
Yeah.
So our process is we want to write the highest quality loans that we can. So the first process is actually vetting our 5 Cs. What's the character of the borrower? Do they have competency? Is there cash flow? We look at all those items, and then we look at security. Now, once we look at that process, it goes through that particular filter. The filter then is the quality of the asset. And then once we look at all of those features together, we then determine what the best risk and reward in relation to that for our investors is. So that is our particular process in relation to deal selection and how we manage to put it in the right fund and offer it to the right investors.
Would you like to tell us a little bit about the Evergreen Ratings experience that you've just been through with both funds?
Look, we were pleasantly surprised. It's slightly daunting when you have an external consultant coming into your business and auditing everything that you do. Your processes, the quality of assets, and then you hope that they actually be able to understand the core of what you actually do and the offering. It's been great. Ultimately, it's a great experience. Also, I encourage everyone financial planners and investors to read the reports because it has so much detail and analysis in relation to what makes Msquared different to the rest of the market.
Private credit as an asset class has exploded in Australia over the past 5 years. How are you seeing the outlook for private credit? How are you thinking about the growth that we're seeing in this sector?
Yeah, absolutely. I think what we've actually seen and the reason why private credit has become so popular, it's obviously all centered around interest rates. Now that interest rates are a little bit higher, it actually increases a heightened risk to other asset classes. And when you have double-digit returns, for example, it's very, very comforting. And there are a lot of fund managers overseas saying, well, why would I take risk on equity when I know that I can get 10%? Talking about the asymmetric risk, it gives you a very good risk and reward. Private credit in Australia is still in embryonic stages to many from different levels. The volume of it. So 70% of all commercial loans in the US is written by private credit funds. It's about 50% in Europe. In Australia, it's about 8%. So we still have a long way to go. And I believe that we have a long way to go from a lot of investors and financial planners advising on it in understanding how to peel back that onion and understanding those different layers of risk associated with private credit as well. And the things that we just discussed, the quality of the assets, how you look at the borrowers, and the full risk and reward assessment. So I don't think we have absolutely matured as much as we have in our overseas peers, but it is growing. It is considered to be one of the highest growth markets in the whole investment segment. According to some statistics that I just saw recently, it's about 20% per annum, expected to grow every year for another decade or so. So let's see what happens, and we're very excited to be in this space.
And lastly, how can investors access your funds?
Well, look, I'm very proudly to say that people can call us direct. Financial planners can access our products as well. We're recently just gone on Mason Stevens' platform, and there's other platforms that we'll be going through shortly as well. We have a dedicated investment team as well, and we look forward to people calling us and us being able to sit down and educate them of all of our features and benefits and all of our options that we can do in relation to private credit with Msquared.
Thank you, Paul. It's been great to have you here today.
Thank you so much for having me.